Howdy, Jacob here. Today we're looking at the company Astrazeneca in the pharmaceuticals industry. Humongous company, 242 billion market cap on 261 billion enterprise value, with growth that has been pretty impressive for a company this large, 26.5 billion in revenue in 2014 to 45.8 billion in 2023. Dividends has been very similar for the last 10 years, slight increase in 2022, but relatively flat. Return on invested capital in the upper single digits, nothing too impressive, but operating margins now in the double digits, gross margin as high as 80%. So great on the gross margin side, good R&D spend. They're spending about 11 billion up from 5.5 billion, so almost double from 10 years ago. And um, good net income, increase of shares, however, they're diluting the owners a little bit. About just under 6 billion cash on hand with 5 billion short-term debt. So good that they have the cash on hand for the debt that's due in the most recent 12 months. But 22 billion long-term debt. Let's see what that equates to. So 22 billion long-term debt in relation to the 5-year average free cash flow. I mean, they have made big acquisitions, and those acquisitions have really given them a heavy production of free cash flow. So honestly, if we're looking more recently, we're probably thinking 7 billion. So 7 billion in comparison to that 22 billion is really not very much. You're looking at just over 3 years there. So I'm actually not very concerned with that balance sheet, but you just have to understand this company appears like it's going to grow from, you're going to get a little bit of a dividend, which pays out a almost 2% yield. So that is above the market, not bad. And then they're going to grow through acquisitions. At least that's what they've done historically. So tiny bit of reinvestment, a lot of acquisition, a little bit of debt reduction, and then a heavy dividend. So that dividend pays out about 60% of their free cash flow of the most recent couple of years, which is a good amount. That only leaves, again, 40% roughly to buy back shares, which doesn't look like they've really done, and then make acquisitions and reinvest back in themselves, which there's things that they have done, as well as reduce debt. So let's start making some assumptions here. So on the revenue growth side, I think that with the ability to make the acquisitions and with inflation and everything, I think 5% seems pretty reasonable to me. I'll put them right in line with the average company due to the fact that maybe they're better than the average company, but they're so big, their growth opportunity is very limited, and most of their growth is just going to be due to acquisitions. And if we go with margins here, let's lean closer to the more recent months. Let's do maybe 13 and 16. And for dividend, I don't want to change the dividend at all because I want at the end of 7 years it to go down to maybe a 45-50% range. For share repurchases, I'm not going to say they buy back any shares because they haven't really done that historically. And so basically this assumption is that from years 1 to 7, they're going to pay a dividend. It's going to go down from maybe a 60% payout ratio to about a 45% payout ratio. And they're using the rest of their money to reinvest back in themselves, make acquisitions to get this type of return and this type of margin. And right now we're saying the company needs about 70% to get the return we're looking for with these assumptions. So it does look a bit expensive. I think it's a good company that doesn't necessarily seem like the best company ever, but I do think it's a good company. And personally, I just think it's a little overvalued for what I think the business is going to operate through with cash flow. So hopefully you enjoy the video. Have a great day. Thank you.